Everybody, Dave here, Hidden Freedom, and welcome back to another video. In today's video, we're going to go over all of everybody's favorite income ETFs, and I do own every one of these income ETFs, by the way. At the very end of the video, we will go in my portfolio. We will look at every one of the positions that I own just to show you that I own them. But we're going to also just make some commentary on how they performed throughout the year as well. And then we'll kind of, maybe talk about some of the ins and outs as well. So, all right, the first one up here is QYLD, which it's one of everybody's favorites. It's not mine personally, but, people like it because of the yield. It does pay 12% there. That's what it paid. And then we also had performance for year to date was 0.49, so basically 0.5%. So in all of 2021, this particular income fund here basically paid out 11.5% on the entire year. So if you're not aware what QYLD does in the background, they basically own all of the NASDAQ stocks, and then they cover calls against the NDX. So that's cash settled. So that's the strategy for QYLD. So that's covered calls. Here is the Qs. This is what we're going to compare the QYLD against, because that's technically what the index is that it's using. And the particular Qs ended 2021 up 26.8%. It pays out about 0.5%. So roughly still 26%. So, QYLD obviously was a little less than half of that. And obviously you need to think about that when you get into something like QYLD. It's not going to perform as well the Qs, and there's a perfect example of that when the Qs are up 26.8% on the year, and QYLD is basically only up 11.5%, and that is including the payout. Next up is XYLD, and that is basically the same from Global X as well, and it is also tracking the S&P 500. So it owns all the S&P 500 stocks, and then they run the covered calls against the SPX, which is cash settled. So it looks like QYLD had, was up 9.10%, and the dividend payout for 2021 was 9.6%. for a total of about 18.7% on the year. That's not bad. That is better than QYLD. And, obviously the NASDAQ didn't perform quite as well as the S&P 500 did for 2021, but let's go ahead and take a look at the SPY. So here's the SPY. This is what we're going to compare XYLD against. So the SPY was up 27% on the year, and it paid out 1.29%, almost 1.3% in dividend yield. So basically, with the XYLD, it didn't perform quite as well, and that's expected because you got covered calls there that cap it. But still, the XYLD still destroyed QYLD in the end. And like I said, the SPY actually performed better than the NASDAQ on the year. So it was actually the place to be. So 27%, don't expect to get that every year. That is not very common. And I don't expect that to happen in 2022. And we can kind of look at the market today and basically confirm that. Next up is RYLD, and this is another one from Global X. And this particular income fund basically runs a covered call strategy against the Russell 2000. The RYLD was up 9.4% on the year, and the dividend payout was 10.8%. So that puts it at roughly, about 20%. And that actually knocked out QYLD and XYLD, which is pretty interesting because the actual Russell 2000 traded sideways a lot of the year, and that's fine because that actually is good for covered calls. Not, contrary to what you might think, trading sideways is not actually that bad. And believe it or not, XYLD, QYLD, and RYLD will actually do pretty good in a sideways market. And not, very well in a down market, and not very well in a very fast up market. So kind of what you really want with these income funds is a sideways market, and that's what the Russell 2000 had in 2021. So I just looked, it does not look like I captured the Russell 2000 index for the capture of the year performance, but it was roughly up about 15% on the year for 2021. So RYLD actually did better than the Russell 2000 did, and that's an outlier compared to XYLD and QYLD. And that's because it traded sideways most of the year, and you can kind of see that here in the actual chart. So here we're looking at IWM, and that's what we're comparing RYLD against. You can kind of see it just basically trading sideways all year. Had a little bit of a spike up there, sold off, but in general, most of 2021 it traded sideways, and that's the reason why RYLD outperformed all the rest of the income ETFs because of that reason right there. Another thing that I noticed about RYLD, which was kind of interesting, and let's talk about that next. So I'm on Global X's website here, and I kind of popped up the holdings for RYLD, and I was kind of baffled. Not baffled. I don't know if baffled is the right word. I was flabbergasted. Maybe that's a better word. That they did not hold all of the Russell 2000 stocks, and that they own VTWO instead, which is the Vanguard Russell 2000 ETF. Vanguard, by the way, this is basically Global X, and they own a Vanguard ETF, and then they run against the cash settled rut. Like that is just like, give me a break here. That is, what's the word I'm looking for here? They're lazy. They're freaking lazy. That's what they're doing there, and they should be owning all the Russell 2000 stocks, and then they should be running against the rut, just like they do with QYLD and XYLD, where they actually own all the underlying stocks, and then they run against the cash-settled index itself, SPX, NDX, in this case here, rut. But no, I was very surprised at that when I saw that, believe it or not. And they're not even running against the IWM. I mean, you think they don't own IWM here, but they don't. They're basically, what they're doing is own the Vanguard, which is super cheap to own. So they're probably not even passing the savings or the income on to you or me, really, because I own RYLD. Anyways, I thought that was interesting, and I don't really know the reason why they do that with the Russell, but they, on the other income funds, XYLD, QYLD, for example, they actually own the underlying stocks. That's just odd to me. But it just goes to show that Global X is all about freaking smoke and mirrors. Here is JEPI. This is one of my favorites right here. And obviously you can kind of see why, because look at this. You add 13.3%. You add that to the dividend yield here, or the distribution yield if you want to call it that. And that is roughly about almost 21%, 7, 8, 9, 10. Yep, that's almost 21% up on the year. And we just looked previously that the SPY was up around 27% on the year. So that's just shy, about 6% less than the actual SP 500. And if you're not aware, JEPI basically has all of the S&P 500 stocks. And it's not really, they kind of go with the lower volatility stocks in the SP 500. It may not be all of them. They're going to kind of hand select the ones that are lower volatility, and then they'll run about just a percentage, not 100% of cover calls using the ELNs, and that kind of leaves it an opportunity to go up more than, say, XYLD would. And that's the reason why JEPI is kind of an outlier there. It's for growth, but it's also for income. And that is a big difference between XYLD. So do not think that JEPI and XYLD are created equal. They are definitely brothers from a different mother. So in my opinion, this is one of the top-notch ETFs, and this is one of the biggest positions I have in my portfolio, which we'll look at here in a second. Next up is Nusi, and if you're not aware, Nusi is basically against the NASDAQ, and they essentially run a collar strategy against the NASDAQ. So they own all the NASDAQ stocks, and then they also run a collar strategy against the NDX itself. So that makes it a collar. It is also for crash protection. It is not going to protect you on a move down, like we had today. And I'm sure people are going to be upset on Nusi's performance, yeah, because I've heard. So I hear it in the comments, I hear it in emails all the time, and they're just not happy with Nusi. But understand what you are getting in with Nusi. You're not getting, it's not going to track what the NASDAQ does. If the NASDAQ goes down and Nusi goes down, that is what it's supposed to do in some cases. Now, if the NASDAQ has a big crash, then Nusi might not crash as much. And that is essentially what the collar strategy is for. All right. So what people think is because the NASDAQ is going up to 10% a month, they think that Nusi should be tracking with it. And that's not how it's going to work. Think of more of Nusi as just a kind of like a bond holding in a way. I don't know how else to put it. It is not going to track like the NASDAQ does. And every time that the Qs go down, everybody gets upset because Nusi goes down. Like today, for example, I think Nusi was down 2% and the NASDAQ was down roughly 2%. A lot of that has to do with when they put the collar strategy on. It was the market up? Was the market down? Did they take the call side off? A lot of it has to do with this. And a lot of it has to do with obfuscation as well, because that's essentially they're running against the cash settled index, the NDX, and they can obfuscate that in the background. But what you get with it is you get a solid return out of it, right? 7.5% there. And then for year to date for 2021 was up 1.5%. That's better than a lot of the other funds. And to pay out basically, was that 9% last year, and knowing that you basically have black swan protection, so you got a Jimmy hat on, right? You don't go around without a Jimmy hat. Well, Nusi's it for you, right? That's the reason why we get into Nusi. We don't get into Nusi to outperform the market. We don't get into Nusi to outperform the Qs. Okay, we get into Nusi for those black swan events. All right. Now, I've talked about Nusi. I've talked about reducing my allocation in Nusi. Technically, I'm just reducing the target. I'm not actually selling out of any Nusi at all. I'll show you my portfolio in a moment. Next up is DIVO, or DIVO. I don't know however you want to say it. I always call it DIVO. DIVO is absolutely one of my favorite income ETFs, and I don't even know if you can want to call it an income ETF. Technically, it is, but it is a highly managed ETF. And so for 2021, it was up 16.75% plus 4.8%. And that comes out to about a little over 21% on the year. And you really can't compare this against any of the other income ETFs that I've talked about today. So that means Nusi, JEPI, XYLD, RYLD, and QYLD, because it's a different freaking bastard child. So what they have is just a portfolio of essentially blue chip stocks that they're running covered calls against opportunistically, so they don't always have a bunch of cover calls on. Sometimes they have 5 on, sometimes they have 10 on, sometimes they only have 2 on. And so basically they handpick the portfolio, go and take a look at their holdings. It's basically top-notch holdings, and then they run covered calls against it, and that will cap some of their positions. But look at that here. We can't really deny the fact that it had a pretty darn good year. We really can't compare it against a specific index, but let's just compare it against the S&P 500. So S&P 500 was up 27% on the year, and this was up 21%. So we did underperform the market, but that's okay, because this is kind of a mix between, basically dividend stocks and also blue chip stocks. So it should perform pretty well in a down market as well. It's not going to just totally tank on you, because it's very solid stocks in there compared to stuff that would say is in the Russell 2000, for example. So this is the reason why I like DIVO, and DIVO is, going forward, DIVO and JEPI are going to be one of the 2 largest holdings in my portfolio, because you're going to get income out of it and you're going to get growth out of it. And that is the reason why we'd own something like this. So this is what we're looking at for today. Today was a bad day in the markets, and it was because of the Fed, the good old government, telling you that they're going to be tapering and taper tantrum, and then you got the raising interest rates possibly 4 times this year. So guess what? That caused a little bit of a sell-off. The market does not like, especially tech, does not like those bond yields going up. And today the bond yields went up. And then so the Dow was down 1% today. The S&P 500 was down at almost 2%. NASDAQ was down 3.3%. And the Russell was down 3.3%. So that just goes to show right there that the NASDAQ really doesn't like the bonds going up. Not to mention everything up the government told basically came out of the meeting today. So let's take a look at my portfolio here. And we're looking, let's scroll all the way down because the largest positions are near the bottom here. All right, here are all my positions. I told you I owned every one of these ETFs that I'm talking about today. There's QYLD right there. I have basically, 2,236 shares. And so about $50,000 invested into QYLD. XYLD, they're about almost 1,000 shares. Roughly a little about $50,000 into XYLD. Nusi right there is another biggie that I own. I told you I wasn't going to, I reduced the target from like 175,000 down. I think maybe it was even 2, I don't remember. Down to roughly about 150 to $155,000. So we're almost at my target there. 5,483 shares in Nusi. Here is DIVO, which is one of the top-notch ETFs, income ETFs that I love there. And look at that. We have roughly about $160,000 in DIVO for almost 4,200 shares. I'll be continuing to build out DIVO and roughly about $175,000 into DIVO. And then we got JEPI there, the largest position in my portfolio at this time, basically about $160,000 into JEPI for a total of 2,544 shares. That position will be continuing to be growing out to about $210,000 is what I project by April of 2022 when I actually retire early in April. So that's my plan anyway. So, and I do own RYLD and I do not have it in this portfolio. So let's go to the other portfolio here. All right, let's take a look at my RYLD position. So we got to go into my M1 account for that because that is where that's located at. And here it is right here, RYLD. Got a small position RYLD at this time, about $2,000 into RYLD, but I do own all of them. I even have BST in there, which I got rid of out of my main portfolio, but it is here in the Schooly Fund. If you're not aware, M1 is also doing, they extended their $50 bonus if you open an account with them. You want $50 for free? All you got to do is open an account with M1, extended to March 31st, and there you go. You deposit $100, open an account, you get $50 free. That's 50% return on your money. So that rounds out the list of the income ETFs that I'm invested in, which are probably one of the most popular ones. And that kind of rounds out the performance year to date. Just know what you're getting in. Obviously a lot of these funds, you're going to cap your upside. You're not going to have any growth at all. Some you're going to have growth, some you're going to have income, and it's always going to be a trade-off, right? The holy grail, like I said in a previous video, is finding something that protects you on the downside, something that gives you good upside, something that gives you a good distribution yield. And in my opinion, that's probably JEPI in this case here. That's kind of the mixed bag between all three of those scenarios because that's not an easy thing to get. You can normally get 2 of them and one of them does very bad, right? In some cases, some of these income ETFs honestly do 2 things bad. So that's just what it is. Like, QYLD, for example, does not have any downside protection at all. It's going to tank big time in a down market. And it's not going to really have too much upside either. But you're going to get a good distribution yield out of it, and that's what you're going to want it for, then that's what you want it for. Just please know why you're getting in these income ETFs. Don't just chase the yield. Know exactly the strategy they're using and understand why you're getting into it. If you have lots of time left in the markets before you call it quits and put a punch card in for the last time, you might not want to be in a QYLD or an XYLD, so just think twice about those. Think twice, check it twice or whatever. So which one of these are your favorite? Let me know. Anyways, if you have any comments, questions, or concerns about this video, please let me know down in the comments section. And anyways, until next time, go ahead and like and subscribe. We'll see you in the next video. Thanks for watching.